Welcome to I Want to Change, where complex ideas get turned into clear actions. In the next 10 minutes, you will learn Bernstein's 4 pillars and a 3-day starter plan to set up a low-cost portfolio that actually works. Pillar 1. Theory, the math of investing. At its heart, investing is about two things: risk and expected return. The relationship between the two is shown beautifully in Bernstein's chart. On the left, you've got near zero risk with cash or bonds. As you move right, you see potential for higher returns, but that comes with more volatility and bigger downswings. So the goal is to find the right balance between risk and return for your needs and time horizon. Diversification reduces unsystematic risk, which is risk that can be mitigated through smart portfolio construction. Asset allocation controls how much market risk you take. Remember, we can't control what happens in the markets, only how much risk we're willing to tolerate while staying on track. And the way to do that is with a well-built portfolio that matches your goals. When it comes to long-term returns, the data shows that asset allocation is the biggest driver, not stock picking or market timing. The rest, fees, expenses, turnover, all eat into your bottom line, so keep it simple. A small number of very low-cost funds covering major asset classes will outperform even the most sophisticated strategies. Most investors don't need alternatives like private equity, hedge funds, or crypto. Let's look at some numbers. Let's say you have $10,000 to invest. For this example, we'll ignore taxes and just focus on pre-tax returns. You're looking at an 8% annual return. Now, if you're young and can stomach more risk, you could put the whole amount in stocks, but that means all your money is riding on stock market performance. Not ideal. So how about a 50-50 split between stocks and bonds? In this case, we're talking roughly half the money in SPY, the S&P 500 ETF, and the other half in BND, a bond fund. This gives us an 8% average annual return over 40 years. But look at the ups and downs. Some years you're up, some years you're down. But here's the kicker. Because of the ups and downs, you can't predict future returns. It's pure guesswork. But here's what you know. Because of diversification, the stock and bond markets historically go up over the long term, meaning there's a good chance your portfolio does too, if you're risk-averse. Maybe you want to go 70-30 stocks to bonds. This gives a lower average return, but also less volatility. What's really cool is that this basic math underpins the rest of Bernstein's approach. Pillar 2. History markets are noisy, but productive. When you zoom out on financial history, you see that markets go up. Crashes and corrections are normal and should be expected. In fact, major crashes are so normal that since 1929, if you've missed the top 10 best trading days in the US market, your annual return drops from almost 10% to less than 5%. That's a massive difference over decades. And the reason crashes are so common is that markets are forward-looking. They price in good and bad news, meaning you can't consistently predict price moves by analyzing historical data. There's no holy grail. Now, this doesn't mean you should invest without thinking. Of course you should. Just don't expect to beat the market by relying on the past. Bernstein's analysis shows that periods of euphoria followed by painful busts are part of the cycle. The Dutch tulip mania of the 1630s, the South Sea bubble in the 1700s, Japanese stocks in the 1980s, and dot-com companies in the late 1990s are all examples of this. In fact, studying market history reveals something fascinating. According to Bernstein, since 1926, CAGR, or compound annual growth rate of the U.S. market, has been around 10.4%. But the arithmetic average annual return, basically the average return each year, is only 6.4%. Why the difference? Because of volatility, the market goes up and down. Some years are amazing, others not so much. But here's the key insight. While crashes and corrections are scary, they're buying opportunities for patient investors. If you believe in markets going up over time, then selling during a crash is essentially selling low. Pillar 3. Psychology. Don't be your own worst enemy. Most investors harm their returns through behavior. It's panic selling when markets fall, chasing hot funds with high fees, or overtrading because of FOMO, fear of missing out. These behaviors all lead to higher taxes, lower returns, and unnecessary stress. To counter this, recognize your emotional biases. Loss aversion makes you feel the pain of a loss more than twice as strongly as you feel the pleasure of an equivalent gain. Herd behavior leads you to follow the crowd, often into poor choices. Overconfidence pushes you to trade too much, overreacting to small market movements. Now that you know your enemies, create rules to counteract your emotions. Automatic contributions to your investments prevent you from making impulsive decisions based on fear or greed. Rebalancing schedules keep your portfolio on track. A pre-committed plan for retirement income removes emotion from an otherwise stressful process. You can also use mental models from behavioral science. If you're tempted to sell, ask yourself, would I buy at this price? If the answer is yes, then don't sell. This reframes your thinking from selling low to buying high. What about specific numbers? How much risk is enough? Well, according to Bernstein, if you can't sleep at night with a 60/40ths portfolio, you're probably taking too much risk. Lower the equity exposure until you're comfortable. Remember, investing should be boring. If it's not, you're probably doing it wrong. Pillar 4. Business use low-cost, transparent vehicles. The business pillar is about the investment industry. Fees, products, and incentives. Costs matter. High fees compound against you year after year. So choose index funds or ETFs with minimal expense ratios and tax-efficient structures. There are thousands of funds to choose from, but most don't make sense. Most actively managed funds do unbeat the market after fees, and most alternative investments offer no diversification benefit. Don't be sold complexity, buy simplicity. Again, let's look at some numbers. Vanguard found that over 15 years, the average stock fund investor earned a net return of 2.9% compared to a 6.8% return for someone holding a broad index fund. That's a whopping 3.9% difference. Here's a simple rule from Jack Bogle. If your portfolio is less than $1 million, you shouldn't own anything that isn't widely traded and listed in the US, UK, or Canada. He's talking about stocks, ETFs, and index funds. That's it. Practical portfolio example and rebalancing. So putting it all together, what does a practical, evidence-based portfolio look like? I suggest starting simple. Total world stock ETF like VTI or VXUS, a small portion to international or value tilts, if you want. And one high-quality bond ETF like BND or BNG. These are just suggestions. Do your research or talk to a fee-only advisor. Then set a target allocation and rebalance annually. If you're younger, you could go 80-20 stocks to bonds. And as you get closer to retirement, shift to 60-40, or even 40-60. Rebalance when your allocations drift outside your set bands. For example, if your stock fund allocation moves more than 5% above or below your target, rebalance back to your target. Automate your contributions and rebalancing and stick to the plan. Common myths and mistakes. Before we wrap up, let's bust some myths and mistakes. Myth number 1, you need to pick the best stocks. Truth, time, and market beat stock picking. Myth number 2, higher returns always mean better choices. Truth, higher returns come with higher volatility and risk. Mistake, chasing past winners and paying high fees. So what about when markets are unpredictable? What's the best strategy? Simple, ride the waves. Don't try to time the market, ride the waves. Day 1, clarify your goals and timeline. Ask yourself, what am I saving for? And when will I need the money? Defining your objective and time horizon helps you determine your risk tolerance and ideal portfolio. Day 2, choose a simple allocation. Pick 2 to 3 low-cost funds. 1 broad stock ETF, 1 bond ETF, and maybe a small tilt if you like. Check out my other videos for more details on specific funds. Day 3, automate and protect. Set automatic monthly contributions. Choose a rebalancing rule and remove hi-fi products. Journal your decisions and set a 1-year review date. Final practical tips and mindset. Keep learning, but don't overcomplicate. Learn the basics. Automate, rebalance. Let history and math, not headlines, drive your decisions. Investing is boring on purpose. Boring decisions often create extraordinary outcomes. I want to change. If you found this helpful, hit subscribe and join me for more practical book breakdowns. If you want to dive deeper, check out the links below. Start simple, stay disciplined, and let time do the heavy lifting. Thanks for watching. one investing step today.